Less than a week ago, gold rose to a new high as investors looked to protect themselves from the impact of the trade war triggered by Donald Trump, his questionable ideas on resolving armed conflict, and more lately, the pressure he has been putting on the Fed chairman. Spot gold briefly touched $3,500 early last week before coming back down towards the $3,300 level on the back of reassuring words from the American president. I'm joined today by StoneX head of market analysis for EMEA and Asia and precious metals specialist Rhona O'Connell. Welcome, Rhona. Thank you for being here with us today.
Great pleasure.
So first, I want to go back to last week and the record of $3,500 per ounce that we saw. Now, roughly since the beginning of 2024, we have seen gold accelerate its ascent and has set numerous all-time highs. But last week's one was different. Can you tell us why?
Last week was a special one. It's one I've been not necessarily hoping for because I'm paid to be neutral.
Yes.
But if we go back to the 21st of January 1980, which is an awfully long time ago, that was the time when gold shot up and the move was sort of like that on the charts as a combination of initially the Hunt brothers trying to corner the silver market, followed in close order by the Iranian hostage crisis, the Afghanistani crisis, and the second oil crisis. And the whole lot culminated. It created a perfect storm. Gold responded accordingly and hit 850 on that day. So if you then use the US Consumer Price Index as a deflator to turn $1980 into $2025, the equivalent was $3,864.
Wow.
So I've been waiting for that to be, I'll start again, 3,486. That's more like it, 3,486. I should know, I've said it often enough.
Very close.
Near enough. So that wasn't ever taken out until a week ago last Monday.
Wow.
So we've now hit an all-time high in inflated terms as well as in nominal terms.
Now, the gold price has come down a little bit. So it's hovering, I think you said actually when you walked in, around 3,270-ish. 70. For the purposes, we're going to go with that right now. Yeah. But the trend is obviously an ascending one. Whether that's due to political uncertainties or the global economy, is this situation likely to persist?
Well, it's been a combination of everything, really. The situation as I see it, if you think about it initially on its own, just looking at a chart, is massively overbought, and it still is, even after that near $300 correction.
Yeah.
From the background fundamental standpoint, it's, yes, you're absolutely right, it's in the ascendant, but it is arguable that with an awful lot of investors now having come back in, as well as a whole stack of new ones, of course, that a lot of the uncertainties about geopolitics and economics and finance, and of course they're all interwoven with each other. It is arguable that the majority of that is already priced in. And I actually think, I would like to think on a humanitarian basis that we might see some of the armed conflicts starting to ease.
Yeah.
It's not looking that likely at the moment with China annoying the Philippines and the South China Sea over the weekend.
And India and Pakistan.
And India, Pakistan.
Yeah.
So it's all still bubbling along in the background, sadly. But it's were any of those to start to show signs of resolution, coupled with the fact that it's arguable just that the worst of the tariff tantrums are through and beyond us. Going to take a long time to get it sorted out.
Unlikely, but
unlikely.
Optimistic.
So it is possible that hitting that all-time high in real terms might actually turn out to be the top of the market.
Okay.
So at the start of this year, I was looking for the price to peak in maybe the second or third quarter. So I'm there to be shot at. I'm going to say for the time being, I think it's done enough. I really do. And if it goes higher, it's going to be for all the sorts of reasons that we don't want.
Last time you were here, you said the magic word was the U word. Uncertainty. There's obviously a lot of uncertainty around the Fed. Trump last week, and while referring to Jerome Powell, said he called him Mr. Slow, threatening to replace him before the end of his tenure. Now, he went back on his words. What impact does some sort of political control on the Federal Reserve mean for the global economy in general, but also for gold?
Yeah, or any other central bank for that matter.
Yes.
But obviously the Fed is the most important one, especially in this context.
Mm-hmm.
I would say that it would be positive for gold and it wouldn't be good for the global economy because the Fed is not necessarily in conflict with the government, but it's there to maintain monetary policy. Congress has handed it a dual mandate for, quote, full employment. That's always a bit of a moving target, but they're probably more or less there as we speak, and aiming for 2% inflation. Now, there's a lot of debate amongst economists as to whether that's actually viable or not. Right. But the point behind that is that the job of the Fed or any other central bank is to maintain policies in a manner which will keep the economy in good order and to maintain stability. And if you get political influence on any central bank, given that, with the exception of a few countries, of which obviously China is one, they have regular elections, that could mean that monetary policy will change every 4 or 5 years if there's a change in administration.
Of course, it's a loss of independence.
Exactly, and that completely throws long-term investment out the window. So it would not be a good thing for either for the economy or finance in general, but it would be good for gold for exactly those reasons.
Now, speaking of good things for gold, now there were heavy flows of physical gold going into the US to preempt any tariffs. But now they're moving back out because of the recent announcements. Can you give us more context as to what the normal situation should be?
Sure. Do you remember normal?
No,
I think I remember normal somewhere along the line.
Yeah, exactly. Hence the quote.
Exactly. Ordinarily speaking, and we're thinking purely about COMEX here, not about any other in any other exchange. It's very unusual for in any trading contract or any active contract for any positions to be closed out physically. It's normally the maximum that you'd expect would be about 5%.
Okay.
So in theory, one could, skin of the teeth, just about get away with only having 5% of the open interest actually held in physical terms in the vaults.
Yeah.
It's never going to be that low. Generally speaking, looking back over the years, the amount of gold that's held in COMEX vaults is equivalent, give or take, to about 40% of open interest.
Okay.
This time around, and we saw it also with COVID, with the problems with flights, but that's a slightly different story. This time around, although it was always going to be very, very unlikely that gold as a reserve asset would be subject to tariffs, risk managers, entirely understandably, wanted to make sure that they got their material in the right place in time. Now, COMEX vaults weren't the only destination for the gold that moved into the States, of course. But it's important to bear in mind here that unlike quite a few other international exchanges, of which the LME is a very good example, they have vaults everywhere. COMEX gold must be vaulted within 150 miles of New York City.
Right, so it has to be home.
It had to be home, on shore. So for much of 24, 23, 22, COMEX gold inventories were between sort of 400 and 500 tons, maybe up towards 520, 530. By the time they peaked, which it will not surprise you to hear was the day after the announcements of the tariffs.
Of course.
That was 1,402 tons. Wow. So they'd gone from 500 odd up to 1,400 odd. So about 900 tons went in. Yeah. And about 200 odd have come out since.
Okay.
And more will come out. And you can see that particularly in the Swiss trade numbers. Switzerland is not the only source by any stretch of the imagination. But because in normal circumstances, the gold format, for lack of a better term, for good delivery, the specifications, 100 ounces or 1 kilo per bar.
Okay.
London good delivery is 400 ounces, which has a tolerance on either side.
Yeah.
That's equivalent to 12.5 kilos. So a lot of material that was coming out of London had to go to the States via Switzerland to be recast into good delivery, acceptable material for COMEX. So things started to back up, which is why it took that much time it took basically December, January, February, March, took 4 months to get it up to that, what was deemed to be a safe level. And at the highest tonnage, that was equivalent to something like 94% of open interest. Oh. So a lot of material went in.
That is correct.
Yeah.
So what is your outlook for gold? Your StoneX analysis outlook on gold, because I'm just going to read something here. JPMorgan, for example, let's talk about JPMorgan. In mid-February 2025, they said that gold will rise towards $3,000 and average at about $2,950 in Q4 2025. Now, last Thursday, JPMorgan again said they see the gold price at $4,000 by Q2 2026. So what is our view at StoneX?
It all makes a market, doesn't it? As I said before, if on a humanitarian basis, I would love to say that it has peaked. All other things being equal, I think it has. It's a very crowded space at the moment. There were a lot of investors, would-be investors last year, who were waiting for a $200-300 correction, and they didn't get it. So eventually it was whatever, and they joined the fray.
Right.
And obviously there's algos and CTAs and so on and so forth, all of which have contributed to this very heady price action that we've had. And that has helped to dry up the physical market to a degree, but the physical market is only a very small part of the whole equation. So if you look at the London Bullion Market Association over-the-counter numbers, and then you gross them up for the market share that the LBMA Local London Material has over the course of a year, just physical market, not futures at all. The physical market, typically in terms of volume, in any 1 year, is 100 times the size of mine production. So it's very much a function of economic and financial forces.
Yeah.
So as we've discussed, I think that the majority of the risks prevailing around the world have been priced into the gold price already.
Yeah.
If it does go to 4,500, it's going to be for bad reasons.
We don't want to be there for that.
We don't.
You're right. Thank you, Rhona. And thank you for watching. For more financial content, please like and subscribe to our channel. See you next time.